Good day, everyone, and welcome to today's deep dive on the silver market. If you're wondering what caused silver prices to plunge from $83.71 to $71.18 on the Comex today, December 30th, 2025, you're in the right place. Before we dive in, a quick disclaimer. This video is for informational purposes only and is not financial advice. Always do your own research before making investment decisions. In this video, we'll unpack the real mechanics behind this sharp drop. Not hype or speculation, but the factual drivers like margin requirements, profit taking, and the key differences between paper and physical markets. By the end, you'll understand why this move was more about systemic forces than any shift in fundamentals, and how it fits into broader trends in precious metals. Stick around for the full analysis. It's essential for anyone tracking commodities or building a balanced portfolio. To set the stage, let's look at what happened on the Comex, the New York-based futures exchange, where much of the world's silver trading occurs. On December 30th, 2025, silver futures opened near recent highs but quickly faced heavy selling pressure. The price fell from an intraday high of approximately $83.71 per ounce to a low of $71.18, marking a decline of about 15% at its peak drawdown before recovering slightly to settle around $72 by the close. This wasn't a gradual correction. It was marked by high intraday volatility, with prices swinging rapidly in thin holiday trading volumes. Data from CME Group, which operates the Comex, shows trading volume spiked as automated systems and large positions reacted to the move. Such volatility is common in leveraged markets like futures, where small shifts can amplify into larger price swings due to stop-loss orders and margin calls being triggered in sequence. Importantly, this drop came after silver had more than doubled in value over 2025, rising from around $30 per ounce at the start of the year to over $80 in recent sessions. This context is crucial. Today's action reflects a pullback within a longer-term uptrend driven by industrial demand and supply constraints. A key factor in today's price drop was the Chicago Mercantile Exchange's CME decision to increase margin requirements for silver futures contracts. Effective as of December 29th, 2025, the CME raised the initial margin from approximately $20,000 to $25,000 per contract, a hike of about 25%. Maintenance margins were similarly adjusted upward. Margins are the collateral traders must post to hold positions, and hikes like this are standard risk management tools used by exchanges to curb excessive speculation during periods of high volatility. According to CME Advisory 25393, this adjustment was implemented to address the rapid price appreciation in silver, which had led to increased leverage in the market. The impact on leveraged traders was immediate and significant. Many participants, including hedge funds and speculators holding long positions, faced higher collateral demands. Those unable or unwilling to post additional funds were forced to liquidate, creating a cascade of selling. Historical precedents, such as the 2011 silver margin hikes that contributed to a 30% price drop, show how these measures can flush out overextended positions. Data from the Commitments of Traders (COT) report, released by the Commodity Futures Trading Commission (CFTC) for the week ending December 23rd, 2025, indicates that non-commercial traders, often speculators, held record net long positions exceeding 74,000 contracts. This positioning made the market vulnerable to a margin-induced unwind, as seen today. Silver's rally leading into December 2025 was one of the strongest on record, with prices surging over 150% year-to-date. This was fueled by a combination of factors, including heightened industrial demand from sectors like solar energy, electric vehicles, and electronics, alongside investor interest in precious metals as a hedge. However, after such parabolic gains, where prices rose nearly 18% in the week prior to the drop, profit-taking became inevitable. Traders who entered positions earlier in the year locked in gains, especially ahead of year-end portfolio rebalancing. Reports from market participants, including those on platforms like X, formerly Twitter, highlighted aggressive selling from institutional desks, rotating funds back into equities amid improved risk appetite. Exchange data shows that open interest in silver futures declined sharply today, a sign of positions being closed rather than new shorts piling in. This aligns with broader commodity trends, where extended rallies often see corrections of 10 to 20% as participants secure profits. One of the most important distinctions in silver trading is between paper markets, like Comex futures, and physical markets, such as those on the Shanghai Futures Exchange, SHFE, or spot dealings in vaults. Comex primarily deals in futures contracts, which are financial instruments representing claims on future delivery, but often settled in cash. Prices here are influenced heavily by speculation, leverage, and financial flows. In contrast, SHFE and physical markets focus more on actual delivery and industrial use, with prices reflecting real supply and demand. On December 30th, 2025, while Comex silver dropped sharply, SHFE prices showed less volatility, trading at a premium equivalent to around 82-85 per ounce in USD terms. This divergence, sometimes as wide as 5 or over 8 per ounce, highlights how paper prices can disconnect from physical realities. Arbitrage opportunities are limited by logistics, export restrictions, and costs, allowing these gaps to persist. China's recent export licensing requirements, set to tighten further in 2026, have exacerbated this, as domestic demand pulls physical silver away from global markets. Inventory levels provide a window into physical supply tightness. On Comex, eligible silver inventories have declined significantly in 2025, with reports indicating a 60% drop in the first few days of December alone, from over 300 million ounces to around 120 million by mid-month. Vault deposits slowed amid the rally, as holders opted to withhold metal anticipating higher prices. Similarly, SHFE inventories hit record lows, dipping to about 531,000 kilograms, roughly 17 million ounces, by late December 2025. This scarcity is driven by a projected global silver deficit of over 200 million ounces for the year, per industry estimates from groups like the Silver Institute. These low inventories amplify price sensitivity, as any surge in delivery demands, seen in over 10,000 contracts standing for delivery in early December, strains available stocks. Today's price drop didn't reflect increased supply, rather it was a paper market adjustment amid ongoing physical tightness. Several macroeconomic elements contributed to the environment for today's move. The U.S. dollar index, DXY, strengthened slightly in late December 2025, rising about 1% amid holiday thin markets. A stronger dollar typically pressures dollar-denominated commodities like silver, making them more expensive for foreign buyers. Interest rates also factored in. The Federal Reserve's policy stance, with rates holding steady after earlier 2025 cuts, supported a risk-on rotation away from safe havens. Liquidity conditions tightened toward year-end, as evidenced by spikes in repo rates and Fed interventions, totaling around $50-60 billion in recent days to stabilize short-term funding markets. These conditions made leveraged silver positions more costly to maintain, aligning with the margin hikes to prompt selling. However, core demand drivers, such as silver's role in green technologies, remain intact, suggesting these macro pressures are transient. Exchange-traded funds, ETFs, tracking silver saw significant inflows during the 2025 rally, with assets under management in funds like SLV surging by billions. However, recent data shows outflows accelerating in late December, contributing to downward pressure as redemptions force physical sales or hedging. The latest COT report for silver, covering positions as of December 23, 2025, reveals managed money, speculative traders at near record longs of 74,466 contracts, while commercial hedgers held substantial shorts at 4,121 contracts. Notably, U.S. banks have shifted to net long positions for the first time in decades, holding over 750 million ounces physically, a sign of confidence in long-term value. This positioning indicates the drop was a shakeout of speculative excess, not a rejection by core market participants. The gap between Comex paper prices and physical premiums, evident in SHFE and dealer markets, matters because it exposes vulnerabilities in the global silver system. Paper markets allow for efficient price discovery but can amplify financial shocks, as seen today. Physical markets, however, reflect true scarcity, with premiums persisting due to industrial needs and supply shortfalls. For viewers, this means recognizing that short-term price drops like this often stem from leverage and positioning, not collapsing demand. Tracking inventories, COT data, and macro indicators helps discern real trends from noise, empowering better decision-making in volatile assets. To wrap up, today's silver drop from $82 to $83.71 to $71.18 on Comex was driven by mechanical and systemic factors. CME margin hikes forcing liquidations, profit-taking after a historic rally, and macro pressures like dollar strength, all amplified by thin liquidity. The divergence between paper and physical markets underscores that this wasn't about waning physical demand, which remains robust amid supply deficits. Key takeaways. First, volatility is inherent in leveraged commodities. Use it to your advantage by focusing on fundamentals. Second, monitor exchange rules and positioning data for early signals. Finally, silver's long-term outlook stays positive due to industrial applications and inventory trends. Thanks for watching. If this helped clarify the market,